You know, it feels like one of those idyllic, lazy summer days, right? But I got to tell you, the market today, we're wrapping up a very strong month. In fact, the S&P 500 is on pace right now for its best month since October 2015. A big part of that has been these fourth quarter earnings reports. However, it's not the earnings results themselves, but investors finding silver linings in these reports. Joining me now to discuss it all, MaxFunds.com founder Jonas Ferris, Key Advisor Group co-owner Eddie Gabor, and Scott Martin is with us as well. He's Chief Investment Officer for Kingsview Asset Management. Scott, let me start with you. There's three things I want to talk about in this segment. I want to start with the earnings because we're almost halfway through. And I always tell people, investors, it's not earnings, it's the market's reaction to earnings. And I got to tell you, the reaction has been pretty positive.
I love it, Charles. You're absolutely right. And earnings, don't forget, my friend, have been better than expected. We thought this was going to be in a word, stinky quarter. Not so much so far. Double-digit growth so far with some more to report. You're right. The market psychology, Charles, has totally turned. I mean, if some of these earnings, let's say, came out in December, like Visa's earnings, for example, even Apple's maybe, they would not have been treated as well or, say, as tepidly as the market is right now. I mean, the market psychology has changed where we're looking constructively, looking for good points instead of bad points in these earnings. And so as more earnings come out, I think it lessens the pressure on a lot of these companies to maybe even guide higher going forward, to reaffirm growth, reaffirm outlooks, because the market's giving them some love.
Eddie, it feels like the old days when there was these whisper numbers out there. So you had the official number, and then you had a number that, wow, we dodged the bullet. Because we have missed a lot on revenues, and while earnings have generally beat, they haven't been gangbusters per se.
No, they haven't. But I think the point is when we had that December sell-off and the bears came out saying, here we go, here's the recession, it set the bar really low. And so expectations going into this quarter's earnings were really low. So anything close to a beat or right in line with expectations is why you're seeing this market have the rally it has. And so that's why you and I spoke a few weeks ago and talked about why we were bullish on the equity markets for 2019. I think January sets the table for a fantastic year. I still think there's going to be volatility, without a doubt. It's not going to go straight up. So for someone that maybe was taking too much risk, may be a good time to take a little bit off the profit short term. But I think for this year, we're going to look at double-digit returns when we look back in December.
Jonas, the earnings parade's been pretty good so far.
It's really good because the whisper was global recession, and these numbers don't jive with the global recession. Boeing just had the first $100 billion revenue quarter. It's good enough. If, again, to the other guest's point, if Apple pulled the numbers they just pulled last summer when there was a 3.25% 10-year bond, it would have tanked the stock. Right now, after a 20% decline, good enough. In fact, what's really supporting, besides these earnings, which are pretty good, is junk bonds are doing well. Interest rates are very low now. The 10-year's fallen a lot since the highs of last year. The whole interest rates are going to cause a recession.
What about the inverted yield curve, particularly after the Fed yesterday? Is that back in play at all?
I think what was more in play was the spread that was going on between risky debt and safer debt. When you see, like, junk bonds, basically, when they're yielding more and more and treasuries are less, that means problems are coming up. People watch that as a canary in the coal mine. That stopped, basically. So I think that's less of a concern. The Fed, you went into patience mode, like Axl Rose, and they're not going to be raising rates anytime soon. So that's also good because it won't invert the curve more. But again, I think watch junk bonds, high yields. That's where you're going to see more of the signal of panic.
You know, Scott, if we have averted a world recession, it's because America. For me, what I see every day when I crunch these numbers, for instance, UPS this morning, the U.S. sales were phenomenal. Americans were using the premium package service. The same thing with Facebook. You know, you have more users. You made a lot more money in America. The same thing with 3M. The same thing, report after report after report. It feels like America is doing so well enough. Do you have confidence that this can continue, that the American consumer, despite plunging confidence surveys, can keep this going?
I do. Being the largest economy for now still in the world, we do have some pull, let's say that. I'm a little worried about the wrangling in D.C., though, because let's face it, the Republicans and Democrats are not playing nicely together. So that obviously, to your point, is putting some stress or some strain on things. But the consumer, by and large, you're right, Charles, in these earnings reports seems to be pretty comfortable. 401k balances, yes, they took a hit in Q4, but we're at all-time highs earlier in the year. They're coming back in January, as Eddie pointed out. So, there's things going on out there. Housing prices have taken a little bit of a dive, but they're not losing as much value as they were towards the end of the year. They've started to maybe base out here. So there's some good things that I think the consumer is starting to feel here that will help propel them further in 2019.
We had new home sales, Eddie, today, and they were pretty good. It was the best number in 8 months, 657,000 annual rate. What was really compelling in my mind about this report, though, the median price has been plunging. We're down 302,000 a year ago. At the same time, it was 343,000. But it means we're moving these mid-tier homes, these $200,000 homes or starter homes. Is there some sort of silver lining in the notion that, hey, maybe we can get that part of the economy going if we start to move homes at a lower level?
Yes, I think that also shows to the strong consumer that we have. And to the other guest's point, with interest rates now not having a worry of the 10-year hitting the 4.25, that should help spur growth in the housing market as well, too, with mortgage rates now coming back in. So there definitely was a point where there was a supply issue on housing and prices got too high. And now I think you're starting to see them reset. And with interest rates staying low, hopefully for the foreseeable future of 19, and prices coming in, that will help spur the housing market in the second half of 2019. But I agree with you. Overall, I think the consumer here in the U.S. is very, very solid.
Jonas, the January effect has got a pretty good track record. Not always perfect, but a pretty good track record. But then we think about 2018. January came out of the gate like a rocket ship. We hit a brick wall January 26th when President Trump went to Davos and declared war on the global elite. Then, of course, we had a whole lot of other things that happened after that. What can we take from the action in this January that might give us some sort of tell for the rest of the year?
In my opinion, there's a global anchor holding down the U.S. economy right now. And we don't know if that's going to drag us down or they're going to get out of their problems, maybe do some stimulus and tax cuts like we did, and everything's going to be great. The whole economy, I think the whole world is a drag right now. And we can't leave that behind. We're doing pretty good numbers, but it's either going to get worse or it's going to get better.
But what's the market telling you? Is the market saying that it can be done, that it might happen?
The interest rate action recently, to me, seems like this year is going to work out. We're not going to have a catastrophe. The housing market slowed down last year because mortgages on the 30-year got to around 5%. That is a breaking point. Most people can't afford that median home at that interest rate mortgage without the home price correcting and going down to make the payment the same. So it's very good for that market. That's why you're seeing pickups now, because now you can get a cheaper mortgage again. So we're at the limits of home prices with rates. Rates can't go a lot higher. That would cause a serious problem for the economy this year. And I think if riskier debt fell again, that would also mean we're going to have a global recession. Those are the two things I'm watching, essentially mortgage rates and junk bond yields.
Scott, the January effect, it's got a remarkable track record with predicting the rest of the year. This has been one fantastic January. Despite all the noise, all the negative headlines, this has been a great year great month, rather, for stocks. Can it continue?
It has. Now, I don't want to pour out the party punch here, Charles, but we had a very abnormal December that we came off of, right? I mean, in a blast down on Christmas Eve, right, before the holidays, where it doesn't make January not as effective. It just makes me wonder if that's really maybe just giving back some that we got, or getting back some that we gave off in December, because that was just so abnormal. So to me, I think to take on Jonas's point from a previous comment, this year is going to be more like welcome to the jungle, because there's going to be months like January that are very good. There's going to be months like February and March that may be tough, and then months after that that may be good. It's going to be a tough sledding. It's going to be a stock picker's market. You got to stay with good, solid companies with good earnings growth.
Now, you guys know I'm trying to figure out some kind of quick, pithy line from, I'm a cowboy and a steel horse I ride?
You can do a
Sweet child of mine, okay. Hey, real quick, Eddie, you're the common sense bull here. You've been bullish, you've been right the last couple of months. What are you worried about, though?
What I'm worried about right now is the slowdown in China and not getting a trade deal done. I think the slowdown in China and a trade deal not getting done could spill over to the U.S. and then bring on recession fears. If we get a trade deal done, I think that puts a backdrop to having a fantastic 2019. But it's not going to go straight up. I would expect to see at least 1 to 2, 6 to 8% drops that we'll see throughout the year.
Wow.
But I think that January is setting the table for a positive 19.
All right, gentlemen, thank you all very much. Jonas, Eddie, and Scott, appreciate it.
It's not going to be Paradise City, is what he's saying.
He's got them all today. Hey,
Not today.
in more than an hour from now, President